Okay, just got the green light to officially launch our Foundation Study of Cycles Financial Cycles Summit, July 12, 14, 2022. And with that, a big warm welcome to all our attendees and new members that have come on board with, I should say, the Market Summit. Apologies for the typo. It's a live stream event with 3 days coverage. So this is actually a new extension in terms of the amount of insights that we're sharing with you over time, with 6 speakers, experts in their own field, of course, sharing the passion and mission for cycle research and awareness. And I just heard from the team that we have another record attendance, actually a significant record attendance compared to last time, in terms of everyone that is here today and has expressed interest in sharing everyone's views on the world, markets, and the cycles at play. Now, just a brief word on a Cycles TV special episode. I was delighted to host this interview with FSC board member Andy Pancholi. The theme was the power of cycles. You can watch it now on our Cycles TV, along with many of the weekly series that FSC board member Lars von Thienen also shares with the Cycles app that our first guest speaker, Dr. Richard Smith, will be featuring. But just as a quick note here, as part of the promotional effort for this event, we do have a Cycles TV special episode interview with FSC board member Andy Pancholi, The Power of Cycles. Very interesting. He will, in the opening segment of that interview, discuss how his predictions of earlier this year came to pass on the geopolitical front, but also then takes a deeper dive in terms of the philosophy of cycles, how it influences life, markets, and much more. I ask him a lot of interesting questions that he thoughtfully responds to. I think you'll all find out of interest. So please watch and let us know what you think with any feedback. And I'm going to review the 3 days ahead by starting today in terms of the 2 speaker lineup. So first and foremost, our chairman, Dr. Smith, will be speaking about cycles, correlation, and volatility. And recall that I just mentioned he will be featuring our exclusive Cycles app and revealing some of the latest insights here and now. And then myself following up as part of the team effort, talking about a roadmap cycle model that I've been developing for many years as part of work with a mentor and colleague, and what that is saying about global markets right now. In short, it'll be looking for asymmetric risk into the second half of this year, but I will segment that into different themes. Day 2 is a special conversation with FSC board member Brad Rotter. That'll be hosted by Dr. Richard Smith. So we're really thinking of different ways that we can share insights here. It'll be less about cycles, but it'll be more about kind of disruption opportunities ahead, notably crypto, quantum computing, and where we go from here. And then, of course, another star board member, Jake Bernstein, particularly in the work of forecasting cycles, he will be looking at interest rates, currency, long-term cycles, and more. You'll recall Jake's insights from earlier this year as part of the previous market forecast event. And day 3, hang around until the very end, because we have some of the best to still come, including our featured speaker, Peter Eliadis. Does not require a welcome. Many of you will know him as a veteran cycle specialist who will be speaking on her cycle theories, projecting future prices and the current US market. On that point, I do urge you all to watch the interview that Peter Lides did with FSC board member Lars von Thienen. It's a great way to learn about Peter's methodology, how he looks at cycles, and what his views were back then, and perhaps compare it to what you'll hear on day 3. And then last but not least, Bill Sarubi, another FSC board member, who will be focusing on US stocks, real estate, and the economy. These are the same themes that were covered earlier this year, but as part of the collective world view, each of the speakers who are speaking again are giving an update on their latest insights and how things may have changed or not. Okay, so before we launch with the real-time market presentations, I just want to share a few words about FSC membership and then just final logistics before we kick off. So what does an FSC membership provide? The key areas that we always like to flag is regular webinars conducted by members of Cycles community, such as the event that we have here, but also much more that we'll be launching soon. FSC community member forums, fellowship of scholars and scientists and non-professional investigators who are passionate about cycles analysis and how cycles can be used for the betterment of mankind. One of the top reasons I hear as to why people want to be part of the FSC membership is to be part of the community. It's a simple but very profound benefit that we all can build on. And of course, we want to make sure that we can encourage further research in the subject as part of the FSC mission and development going forward. And then, of course, Cycles app, which will be featured in our first presentation with Dr. Richard Smith, is a unique and exclusive tool here at FSC that can decode cycles and apply cyclic analysis to detect dominant cycles in any data set. And I do want to stress the any data set point. It is market data, but it can also be other data that you put in to the model. And then last point, a big thank you to our members for supporting the FSC, which is, of course, a nonprofit. You are helping to fund all of the events and material planning to release in this year and following years. Remember that helping and supporting is multifaceted. Donations, of course, is the traditional way. Continued support in raising awareness is another. And also, as part of a greater collective effort, contributing ideas, time as part of a community is always going to be key. If you want any more information about the FSC organization and follow up as to how to donate or support, please visit our website for more details. You can see the link down there at the bottom of the screen. And our team will also share a link specific for the donation option for those of you who are interested to support in a monetary fashion. Okay. With no further ado, I'd like to introduce our first speaker, who is also the chairman of the Foundation Study of Cycles, Dr. Richard Smith, who will be speaking about cycles, correlation, and volatility. A brief intro. Dr. Smith is a financial technology pioneer, founder of Rick Smith, a risk management app for retail investors, and author of Risk Rituals, a weekly newsletter evangelizing about risk management. As the former CEO and founder, he grew trade stops to more than 30,000 retail investors who entrusted his technology with a staggering $20 billion. He has been featured in Business Insider, MarketWatch, Forbes, CNN Business, Newsweek, Money, BBC, and more. And just as a light personal note, Richard, you've been a wonderful leadership of the foundation. Thank you for guidance, vision. Excited about the future ahead. We've had many discussions before as to what that future will likely be. But right here and now, let's hear from you about cycles, correlation, and volatility. Welcome.
Thank you, Ron. It's great to be here. Great to be with everybody. Wonderful collection of people from all around the world. Really incredible. So thank you all for being here, and thank you all for your support of the foundation. We literally couldn't do it without you, and it makes it so much easier when we see how excited you are and how responsive you are. So it makes our work a lot of fun in that when we get that great feedback. So thank you again. All right, let's dig in. Let's get started. I am Richard Smith, and I'm the chairman and the CEO of the Foundation for the Study of Cycles. So before we get into the cycles stuff, I just want to start out with some big picture, philosophy, psychology, and then my view of the overall economy. And then I'll get into some of the cycle stuff. So first of all, we've just been through literally the worst 6 months in markets ever. Stocks did slightly worse 1 year in the 20th century, but with stocks and bonds combined and just financial assets in general, literally this is the worst market in history. It's incredible to think back to even October, November, even January and February, the Super Bowl, the crypto commercials, etc., and then to get whacked with the worst 6 months in market history. These are very, very difficult markets, unprecedented, really. I see not only novice investors getting really hurt. I see seasoned pros getting beat up by these markets. There's really been nowhere to hide. So as you are contemplating your engagement with the markets, I think you really need to keep it in mind that this is a tough time, and this is not a time to think about crushing it. This is a time to think about surviving. So this is not to be taken lightly. I'm always focused on the big picture, and I am frustrated with the way retail investing is so much just about, oh, buy this, sell that, top this, bottom that. We need to get our focus off of individual events in our investing and onto our total portfolio performance. So this is the risk management piece. I've been at this for 25 years. Some of the other presenters have been at it longer, but 25 years is enough to learn a few lessons. And the biggest lesson is that it's discipline, and it's looking at your whole portfolio that really makes the difference in between success and failure. So going to be building on that theme as we look at cycles today and look at how we can put together a portfolio based on cycles ideas, and not focus so much on, is this the top? Is this the bottom? Is that one going to go up? Is that one going to go down, etc. All right. So a couple of years ago, I got to interview Jack Schwager for the Foundation for the Study of Cycles YouTube channel, and it still really sticks with me. When you ask Jack, well, what do all the market wizards have in common, right? Number one, they're all utterly unique. Okay, they all have their own style, and that's a lesson for us because we've got to develop our own style. We get this software, we get this data, we get a brokerage account, and we think, man, we're good to go, right? No. It takes years of work and study and practice and getting burned and hopefully not wiping yourself out to ultimately develop your own style and tune out the noise, right? So, and then secondarily, but they were all pretty religious about risk management. Every single one of them was religious about risk management. So you got to develop a unique style, a unique set of indicators, something that works for you, okay? And you have to be religious about risk management. And finally, all of that gets you into the position that fellow board member and early mentor of mine, Jake Bernstein, famously said to me nearly 25 years ago when I asked, what's the difference between the winners and the losers? He said, the winners don't need the money. And, I'm a novice investor 25 years ago thinking, the rich keep getting rich and the rest of us keep getting the shaft. And yes, that there is some truth to that. But the bottom line is we have to put ourselves in a position to not get, jerked around by the markets. How do we do that? By knowing what we're doing, having a solid edge, and using good risk management. That's the key. That's what gets us into the position of not needing the money, right? Not being forced by the markets to, shake the change out of our pockets, right? Because we're in too big of a position, or not put enough money into our pockets because we're in too small of a position. So how do we get ourselves into a position that we don't need the money, yet we're in the markets and we're making things work for us? So there's just a little bit of behavioral, psychological, philosophical background, but this stuff is key. If we don't have this, it doesn't matter what tools, what data, what secrets, what tips we have, we are not going to succeed. All right, so there's a little bit of philosophy for you. Now, I just want to give you a picture of what I think is really driving the markets more than anything. And this came from my friend, Ben Hunt over at Epsilon Theory. Ben does amazing work. And Epsilon Theory is a great community, another great community of thoughtful people and investors and people looking at our current situation, trying to understand what's going on. So Ben showed this chart the other day. I've made some variations on it, but what are we looking at here? The orange line here is the total net worth of the people in the United States of America, okay? And the blue line here is the gross domestic product of the economy, and this is going back to 1948. So you can see in here, that they're kind of running along in parallel. Our wealth is more than the GDP, typically about 4 times more. But then you really see them start to diverge over the last 20 years. And to make this a little more graphical, the next line here is the total wealth, okay, divided by the GDP. So it's a ratio, right? How much bigger is our wealth, total wealth, than the gross domestic product of our economy? You'd think that these would stay relatively intact. And what we see here is that, where's my cursor? There we are. From 1948 up until 1998, our wealth was typically about 4 times our, 3.5 to 4 times our gross domestic product. But starting in 1998 and into 2000, right, in particular, this really started to diverge. Our wealth became much greater than our gross domestic product. Our wealth was growing, but our gross domestic product was not growing as fast, right? And so today we have a factor, this was the end of 2021, it's almost 6 times. So we feel wealthy in the United States, but there's something odd going on that has created this wealth effect, right? That is not more productivity out of the economy, okay? The economy has continued to grow at a similar pace, maybe even leveled off a little bit, right? But wealth has been shooting up still. I believe that's come from financial engineering, that's come from lower interest rates, that's come from starting with Alan Greenspan, a Federal Reserve who's been very free with the economy and always had the Fed put there to, not have anybody be disappointed or lose an election or whatever it is. So this is what I think the big headwinds that we're facing is that a lot of what I would call a wealth effect that's not real wealth has been engineered over the past 20, 30 years. You see it, starting here with Alan Greenspan was chairman of the Fed from 86 to 2006, right? Ben Bernanke came in then, et cetera. So all of this is a real problem. And I think ultimately, this is going to revert back to more traditional levels that we've seen. So I think that is a serious headwind that is going to drive the next decade of market activity. That is my big picture of the markets. And that's the kind of the top of mind thing that I'm always thinking about when I'm thinking about how to position myself in the markets. All right. So moving on now. Here's where we start to get into the risk management piece. And this was a little illustration that I made of a portfolio made up of 12 stocks. Okay, so this is the total performance of the portfolio here over 1 year. Went up about 12, 13%. And then, but that portfolio was made up of 12 different stocks. Okay, now I'm going to show you what each of the 12 different stocks did relative to the portfolio as a whole. Right, so here's stock number 1. Right, went down, up, we're frustrated, it's not doing what we want. Oh, it's on a tear. And finally, ultimately ended up, 15, 16% gain for the year. Great. All right, stock number 2. Off to a great start, flatlining, coming down, back up. Yeah, ends up disappointing us. Stock number 3. Pretty good, right? It was more or less solidly up over the whole year. A bit of a correction, but nothing terrible. Went back on a good run, ended up with 15% gain. So you get the idea here. These are different investments. That one did almost 20%, right? Here's another one, stock number 5, also almost 20%. Stock number 6, 10%. Stock number 7, 25%. We wished all of them could be like this, but they can't. Another great performance for the year, number 8. And then number 9, okay. Pretty tough go of it mid-year. Climbed back up to break even or to match the portfolio. There was a disappointment, but you get the idea. So this is a portfolio of investments that ultimately your goal here is this blue line up the middle, but all your different investments are doing wildly different things. So how do we get a smooth blue line, middle of the fairway, not a whole lot of ups and downs in the overall portfolio, right? Meanwhile, the different elements of the portfolio are going up and down all over the place. So the way you do that is by having uncorrelated investments. So all of these different 12 stocks that I just went through, overall, they all were going up, some of them more up than others. Some of them, not up, but not too far down, right? And that's what gave us this smooth ride as opposed to all the different volatility of the different investments, that we might have been in or not been in. So we need to focus on the portfolio as a whole and not really, get caught up in what's going on with the individual components of the portfolio at any one time, okay? So that's the big idea. That's something that I've been working on of how to help people do that because I don't think this is very accessible right now. So I know this is a little busy, but this is a correlation matrix. Oops. Showing a lot of different futures here. So bonds, 10 year, 2 years, 5 years, Bitcoin, some commodities, some stocks, Russell 2000, S&P 500, silver, etc., right? And the white squares are things that are not correlated to one another. The dark green squares are things that are very correlated to each other. So the bonds are very correlated to each other. Here, the Russell 2000 and the S&P 500 are very correlated to each other. So almost perfectly correlated. So we're looking for investment opportunities that we can time with cycles and to ultimately make a portfolio of complementary investments that are going to give us a smooth overall ride in our portfolio. Some of them will be going up sometimes while others are going down sometimes. But how do we get a collection of investments that we think have a good chance overall of going up over the period of time that we're investing for, and that are going to complement each other, so we get that smooth, more reward, less risk experience in the markets. That's what I'm always aiming for. And to me, this is the key, because what undoes us in the markets are our emotions, right? And our ideas. And we're constantly being assaulted by the markets and by the media. And if we are not in the position, that we don't need the money, because, this is a smooth ride that you're not going to be losing sleep over, how do we engineer this, right? We do it with correlation and with volatility. So let's get into looking at some specific cycles now. I'm going to use our cycle analyzer app, and then I'm working towards a portfolio of cycles-based trades that we can make over the next year that are going to take into consideration correlation and volatility. All right, so I am going to jump over here now to our cycles analyzer. And I am logged in here to cycles.org, our website. And I'm going to go to the Cycles app. So I do have slides of all this too, but I just want to show you how I use the Cycles app in real time here. All right, so here I am. I'm just went straight to the Cycle scanner. I'm going to source my data from Yahoo Finance. So I'm going to use tickers from Yahoo Finance. So the S&P 500 is GSPC. That's the ticker at Yahoo Finance. I want to start out by looking at long-term cycles. So I'm just going to look at weekly cycles. So I'm going to use the -W appendix to the symbol. So GSPC-W, and then colon YFI to say that I'm getting this data from Yahoo Finance. All right. So it's pulling that data, it's doing a scan, and it's pulled in data on the S&P 500. Thank you, Yahoo Finance. That goes all the way back to into the 1950s. Okay, I'm not going to go back that far, but I do want to start out by taking a good, long look, maybe a 50-year look at what's going on with cycles here. So I'm clicking this anchor over here for my start time. Okay, and my end time will be all the way there at the end. And then I'm going to refresh this analysis. And now the dark blue data is all the data that is being used as part of this analysis. And the light blue is out of sample. Okay. If I wanted to, I could also set, an out of sample on the future here too. Go back maybe a year. But I'm not going to do that right now. So I've run this analysis on 50 years of data, on weekly data on the S&P 500. I'm going to slip down here to this spectral analyzer, and I'm looking for peaks here. This is length, cycle length along the horizontal axis, and I'm looking for green triangles. So 182 length cycle, Bartels of 96, and strength of 3.64. That's great. I also just sort by length here. And I look for the cycles that have the highest strength and the highest Bartels. So here we have, you can see the 182 week cycle. Okay, there's also a 396 week cycle. That would be interesting to look at. Let's take a look. Doesn't bode well. For what the next, how long is this cycle, bottom to top? That was June 18 out to February 22. So that's almost 4 years. So in terms of the longest valid cycle we got right now, the 396 week cycle, okay, that's down on the S&P 500. I really like this 182 week cycle. Okay, so I can zoom in on that. It is also down on the S&P 500. And you can see, how this cycle has performed over the past couple of decades, right? Pretty good catch of a bottom here, pretty good catch of a bottom here, not a bad catch here. could have been frustrating here, but ultimately got that COVID spike down to a bottom-ish in 2020. And now we're well into, the next 182 weeks. What is that? About 3+ years. So half of a cycle would be, year and a half or so, bottoming into April of 23. And I still think that feels about right to me, because I think we're in a market similar to the 1973 market, and that was about an 18 to 20 month correction that ultimately went down almost 50%. So I think overall we're about halfway through our correction at this point. So my long-term cycles in the S&P 500 are pointing down. Now I'm going to get rid of the weekly data and just look at daily data. And for daily data, I like to typically start with about 5 years of history. So I'll go to range and choose 5 years. And set my starting anchor, say, middle of 2017. And now I'm going to rerun or refresh this now that I've got my start and end points. And I'm using about 5 years of history now for this analysis. This cycle jumps out at me, 171, very strong Bartels, very strong strength, 6, almost 7. I can also see that if I just sort by length here. Okay, so this 171 day cycle, very strong Bartels, and pretty much the strongest cycle in this daily data. So if I plot it, okay, you can see that on the daily cycle, okay, 171, that's actually close to, 3 quarters, so almost 9 months, peaking probably in late August. So it wouldn't surprise me to see a significant rally in the S&P 500 over the next month. But overall, I think that the headwinds are against further progress in the S&P 500. And that also jives with my, my growing sense that the wealth effect has been created by artificial financial engineering based on lower and lower interest rates, and that's gone. And so there's some pain to be felt to make up for the lack of pain that we've suffered over the past couple of decades. All right, so if we want to take it one step further, we might look at even shorter cycles, go back maybe a year or 18 months, let's say to the beginning of 2021, start a new analysis. And when we're looking at these shorter term cycles, 86 days, 37 days, depends on how short you want to go. Let's try the 37-day cycle. Zoom in here now. And that's also pointing up. So into July, end of July. So I think for the S&P 500, the long term is not good, but we could well have a significant rally over the next month or two. And I'm using a fractal approach here, right? I'm looking at long-term, medium-term, short-term, and trying to get a sense, if everything's aligned in my favor, right? Or if maybe I need to wait for a little bit to get on a short, or maybe take some partial profits, and if I'm expecting a counter trend rally, et cetera. So I use a fractal approach to cycles. This is all analysis that you can do with our Foundation for the Study of Cycles cycle analyzer that's included with your basic membership. Everything I'm doing here is with a basic membership. All right, so that's the stock market. Let me just give you one more example here. I want to look at 10-year Treasury futures. So again, I'm just going to use some data from Yahoo Finance. ZN equals F, that's the futures data. I want to look at weekly data. I'm going to pull it from Yahoo. All right, so a brand new analysis here. Gives me data back to 2013. Let's see if I can get some more. Give me max. Still only back to 2012, 2013. Hey, that's 10 years. We can work with that. I'd like to get a little more, but let's work with that. So over the past 10 years, we're using all the data, right? It's all dark blue. We can sort by length here. We've got a 214 week cycle, good strength, good Bartels. We can go down here and see in the spectral analyzer, there's the 214 week cycle, good Bartels, good strength. I like it. And if you look at it, it's a pretty incredible cycle in terms of tracking what 10-year treasuries have done over the past decade, right? And where are we? We are bottoming. So don't be surprised if treasuries start going up. You don't necessarily want to try to catch a falling knife. I'm not getting into timing, kind of supporting indicators here. But if you've been short treasuries for a while, time to start thinking about taking profits and thinking about going long. All right, so that's the long-term picture in treasuries. Let's go a little shorter. Okay, let's move out of the weekly data, go to the daily data. We'll get our 5 years of history. Okay, we'll go back to, say, middle of 2017. Let me grab my starting anchor. Run it. And what do we got? Sort again by length. We've got some good cycles here in the 168, 195. Good strength, 3.89. 80 Bartels. We can go down here and look at the spectrum too. Here's the 168. Here's the 195. Could try to combine them even, what's the 168 plus the 195? But I think I'm going to stick with the 168. It's got the highest strength and the highest Bartels. I like to keep things simple. You don't have to be right all the time. You just want the wind at your back and not, holding you back. And you want to be using good risk management. So based on that, another bullish cycle, medium length, okay? And then finally, we can look at the past 18 months or 2 years, do a new analysis, find the strongest cycle here. And we've got probably like the 74-day cycle here or the 54-day cycle. Let's take a look at the 74-day cycle. Zoom in a little bit. A little bit of a headwind with the 74-day cycle coming to a bottom on middle of August in about a month, right? So pretty serious tailwinds in bonds with a little bit of a short-term headwind, but this is the way that I like to do cycles analysis. And now I'm going to, I'll just stop for a minute, Ron, and see if anybody's got any questions. Especially about how the cycle analyzer works. Is this coming through clearly? Yeah, any feedback, Ron, or questions?
Yes, so we have a few questions here. One from Rich saying, general question on grains, meats, metals, softs. Do they all work on the cycle scanner? Has been looking for them, but no luck so far. So more of a market logistical question there.
Yes, you can do. Let me just see here. So if I go back to the cycles analyzer here, grains. Let me just pull up a page here. Let me go to Yahoo Finance. We go to markets and futures. Okay, all of these future tickers are here. So if you want to look at what you mentioned, live cattle or lean hogs. So lean hogs is HE equals F, live cattle is LE equals F. Everything's here, pretty much. Whatever you want to analyze is here. So if I go over here and I do LE equals F, scan. So I'm getting daily data here on, I think this is lean hogs. I can grab 5 years if it's available. Looks like it is. Oops. And go back to 2017 or so. Put my starting anchor in, run an analysis, and voila. There's a 242-day cycle, good one. In lean hogs, good 166-day cycle. We could plot them, see what's going on, as well as the 166-day cycle, combine them both. This is amazing technology, and it does it instantaneously. So you can imagine what Edward Dewey would have thought if he could have seen this himself. All right.
A follow-up, Richard, on time frame. So you mentioned fractal analysis, looking at long-term, medium-term, short-term.
Yeah.
And there was a question here, which would be great to expand on if you wish, on how useful would it be to look at the longer-term time frame and specifically monthly?
I think it all depends on what your investing time frame is, right? So if you're day trading, you don't need to worry about monthly cycles. If you're putting together your portfolio, for a 25-year investment strategy, monthly cycles could be relevant. So it really depends on what you're doing as an investor. If I had monthly data, I would use it myself. But I think for most of what most of us are doing, monthly data cycles are hard for us to follow, because you're thinking in terms of decades there.
Roland's asking kind of a visual question about the bottom screen, bottom left, where it says dominant cycle. If there's any insights you can share on that.
The dominant cycle is just a feature of the software that attempts to pick out the best cycle. But the best cycle changes based on what period of time you're looking at and how much data you're using, et cetera. So if you want to focus on the dominant cycle, you can. It's an excellent, if you want one cycle and you don't want to do the analysis yourself, the dominant cycle is good. I like to do my own analysis and to use this kind of fractal approach. And I even, will do the same analysis on intraday data as well. That's not available through the Foundation's software, but it is possible from the Lars von Tienen and his Win2Trade service, which is what powers our cycle analyzer. I can actually hook the cycle scanner up to essentially intraday data out of TradeStation, and I can do intraday analysis on cycles. So you can do it all. But let's carry on and get through the rest of the presentation and then take more questions. So
thank you, Richard.
I'm going to jump over, instead of doing this analysis real time, I'm going to jump over now back to my PowerPoint here. Let me just get this. You guys can't see that, but it's bothering me. All right. So here's the US dollar. This is weekly data. And the US dollar has been on a tear, right? And one other thing I just want to show you, if we go back to our correlation matrix here, I've got the US dollar right here. And you can see that the US dollar is negatively correlated to a lot of stuff, right? Negatively correlated to bonds, negatively correlated to Bitcoin, to coffee, copper, to the S&P 500, to silver, Russell 2000, et cetera. So the US dollar has been a serious headwind in the markets to a lot of things lately because it's negatively correlated to them. So I did some cycle analysis of the US dollar, and we're clearly, on the long-term cycles. We're in a bullish long-term cycle still, although we're getting very close to the top. We're in, within 10% of the top, and usually 10% is a good kind of rule of thumb to start looking for that bottom or top to be relevant. But if you look at this 175-week or 3.4 year cycle, in the dollar, it's been pretty powerful. It's worked pretty well. This is topping, towards the end of 2022 on the long-term cycle. On a shorter term cycle, this is a 6-month cycle, 185 days. Again, doing that same type of analysis through that I just showed you, is at already past the top, okay, on the medium term cycle, and also past the top on the short term cycle. This one's 39 days or about a 6-week cycle. So I think the dollar's rally is starting to be called into question. You don't want to fight, something that's screaming higher, not trying to, time the top perfectly. But I think overall, this rally is in its last stages, and we probably should see the dollar start to fall before too long, which will have a, elevating effect on many other assets that the dollar has been holding back, especially for US investors. All right, gold. So same approach. Long-term cycle is still bearish into 2023. So this is a 4.5-year cycle in gold. All of this was done right out of the cycle analyzer. But getting, we're within 10% of the bottom on the long-term cycle. I know, 6 more months of a bear market in gold doesn't sound very attractive, especially to me. But that is what the cycles are showing us. And meanwhile, on the shorter term cycles, like a 6-month, we are literally at the bottom of the cycle right now. And then on the shortest cycle, like the 6-week cycle, we are also at a bottom. So, could we see a good counter trend rally in gold? I think so. I think there's still some headwinds into 2023 from the longer term cycle, but overall, I think that gold is pretty interesting at this level. It's also interesting as you look at all these to see how many of them have, 6-week cycles, 6-month cycles, 4.5-year cycles, et cetera. So that's really interesting, the synchrony of cycles. All right, and I'm choosing these assets to look at, again, by looking for assets that are uncorrelated to one another, or at least minimally correlated to one another, to ultimately put together a portfolio. And another asset I picked was lumber. And let me just jump back here to the correlation matrix. So here's lumber right here. The same assets are along the bottom of the chart here too. So 10-year T-notes are perfectly correlated to themselves. 2-year T-notes are perfectly correlated to themselves. That's what this bright green diagonal down here is. Everything perfectly correlated to itself. So lumber is like uncorrelated to practically everything. Amazing. So it's minimally correlated, and minus 0.1 to plus 0.1 to literally everything else. So that interested me. And so now I'm going to go back and look at the cycles here. Get this thing out of my way again. All right, so lumber, we've got the long-term cycle, again, 3.5 years, 189 weeks. Nice downtrend going. But we're already seeing a bottom, on a 6-month cycle with a bounce. and also on the shorter term, in this case, 7-week cycle, getting a bottom. So longer term cycle headwinds, but medium and shorter term cycles starting to look up. And then I did natural gas too. Pretty incredible cycle here, 4-year cycle. I mean, look at these bottoms and tops. They're like boom, boom, boom. You know, little wishy-washy, finally getting the top there, bottom and top. Also topping in the medium term cycle, about a 1-year cycle. And moving into its bottom of a shorter term cycle, in this case about 4 months. So bottoming on the short term, but still bearish on the long term and medium term cycles. And then finally, I did Bitcoin, 3.3-year cycle, 170 weeks. It's pretty good cycle. Not perfect, but pretty good. We're clearly in the bear phase of it right now. This is also in a log scale, so it doesn't look as dramatic as because it's percentage changes basically, as it might look on other price charts, but getting near a bottom. Okay. On the medium cycle, the 1-year cycle, we're in the upswing of that cycle, even though it's still going down. And then finally on another medium length cycle, also bottoming here. And then the shortest cycle, the 33-day cycle, looks like it should bottom here in another week or two. So by end of July, a lot of cycles are going to be looking up for Bitcoin. All right, so let me pull this all together. I've made this little chart, little table. The S&P 500, bearish, very bearish, very bearish, but bullish on the short term. I'll get to these numbers here in just a minute. 10-year treasuries, bullish, bullish, bullish. Gold is bearish long-term, bullish medium, bullish short. Bitcoin is the inverse. Bullish long-term, bullish medium-term, bearish short. Lumber, bullish, bullish with some long-term headwinds. Natural gas, bearish, bearish with a short-term cycle. And then the US dollar, bearish, mildly bearish, very bearish, very bearish. All right, so out of these now, I can form a portfolio. And last thing I'll just mention here, this D score here, this is essentially, you can think of it as a measure of volatility. For those of you that know risk management, it's technically a 95% value at risk score. So what this means is, what should you expect your worst day of the month in this asset to be if you were invested in this asset? So a 2.5% loss, you should expect that at least once a month in the S&P 500. But for 10-year treasuries, your worst day of the month is probably going to be less than 1%, right? Because it's not as volatile as the S&P 500. Gold, about 2%. But then you get into Bitcoin, lumber, natural gas. These things are volatile. So I like to allocate position size by volatility. So I put more money into the less volatile things and less money into the more volatile things. Okay. So now I've got a collection of assets that are relatively uncorrelated, right? If we go back to the correlation matrix here, the S&P 500 and 10-year T-notes right here. Okay. Not too correlated. What else do we have? 10-year T-notes. T-notes and gold, where's that? Here's gold, a little bit of correlation there. Also, let's see, gold versus the S&P 500 is a little bit negatively correlated right now. So between those two, you're kind of balancing out. So we're getting uncorrelated, and then we're going to allocate by volatility. So I'm going to finally wrap this up now by taking you over to, this is the tool that I've been developing. It's called RiskSmith. You can sign up for this for free right now. And here I have taken the ETFs that correspond to these different assets. So SH here for the S&P 500 is the 1X short S&P 500, because, let me go back here. I think overall I want to be short the S&P 500, although I do have this short-term cycle that's up. Maybe I'll wait a little while to go short, but overall I want to be short the S&P 500. And then wood is an ETF for lumber. IEF is an ETF for treasury bonds, GLD for gold. KOLD is a 2x short natural gas, right? So if we go back to our chart one more time, or our table here, right? We want to be short natural gas, long lumber, long Bitcoin, long gold, long treasuries, and short the stock market. And we want to just keep an eye on the US dollar. So that's what I have put together here. And you can see this is a covariance matrix, the same kind of thing, correlation, right? So wood or lumber is not very correlated, although negatively correlated to the S&P 500, et cetera. Bonds correlated to gold, but not that correlated to everything else. So this is how you use correlation. And then the last thing I just want to show you here is volatility. Let me go back to the grid view here. So we've allocated these positions so that less of the money goes into the more volatile stuff and more of the money goes into the less volatile stuff. So 40% of this portfolio is in treasuries, 23% in gold, 15% in lumber, 16% short the S&P 500, only 2% in the short natural gas, because not only is natural gas volatile, this is a 2x volatile ETF on natural gas, and then finally Bitcoin, about 5% of the portfolio. And when you combine all those, this is a little more than I have time to go into right now. I'd love to explain this more in another session, but this gives you some risk metrics that you can track on this portfolio and start to really think in terms of portfolios and think in terms of correlation and volatility, right? And combine those with cycles so that you can have good timing, and then using correlation and volatility to ultimately put together a portfolio of complementary uncorrelated assets, right? Proportional to their volatility. So I know that's a lot. Happy to take questions. This recording will be available for you to go over again, but this is my overall philosophy of investing, trading, all forms of speculation. We have to have good, our definition of good, Ray Dalio called it Holy Grail portfolios, good, uncorrelated return streams. So good, in this case, we're using cycles, timing indicators, and uncorrelated, right? We're using correlation, and then also position sizing based on volatility. That's how I do it. And everything that I've shown you today, both the cycle analyzer and the RiskSmith app, are free. Sorry, the cycle analyzer is part of the membership. It's free with your membership. And then the RiskSmith app is free right now. And we're working on getting the futures data into RiskSmith. It should be in there maybe even this week. So with that, Ron, I have got in under the wire of an hour. I'm sure there may be questions, but floor is yours.
Thank you for a wonderful, wide-ranging number of insights, Richard. We went through the philosophy of cycles to the probabilities and portfolio management, all the way through to the Cycles app. And we also managed to take in some questions midway. So if we could just follow up on that to keep our audience happy with more questions.
Sure.
I see, one second. There was a question, well, I think you touched on it, oil. So we had some commodity hungry audience members just wanting to know on the view on oil. I believe that was bearish on Cycles app. Is that correct?
I didn't do an analysis. I can jump back and do an analysis on oil if we have a few minutes, but let's see what other questions there are.
Yes. Okay. Sergey is saying crypto winter ends in a year, so that might tie into some of the perspectives. Johnny's asking access to the Risk Smith system.
Yes, Risk Smith, risksmith.com, and you can go there and sign up for free. So it's in a beta phase of development right now. So we love having people in there, putting it to the test for us. It's working really well, but it's still free. And and some version of it will be free for a long time to come. There will be upsells eventually, but there's a lot of value people can get out of it for free. So it's an incredible tool.
Albert's asking about the calculations of allocation weightings.
Yeah, so we're doing that based on volatility. So again, it's inverse to the volatility. If I jump back over to, let me just go to the app here. So get this out of the way. Let's look at another portfolio. These are, yeah, it's not a good one. So what we're looking at here, these are histograms that show the daily distribution of returns, right, over the past year. So you can see for things like gold, it's more kind of bell curve like shaped, whereas for more volatile assets like AMD, it's more spread out and you have these what are called fat tails. And so when you see kind of the returns, like this is minus 5% in a day, and that happened like 30 times over the past year, plus 5% in a day, right? Whereas that's a lot more, that's pretty rare in gold. Returns are usually between, plus and minus 2% in a day. So that gives you an idea of the volatility of different assets, and then you can weight these by volatility, or you can equal weight them. And then when you do change them, you can see how your risk profile changes. This is the distribution, the histogram of your whole portfolio. Okay, whereas when you're volatility weighted, it kind of tightens things up because you're more in your less volatile assets, more weight in your less volatile assets. So it does the math for you, but it's pretty simple. You just take the volatilities. You can use standard deviation if you know what that is, and then just weight your position sizes inversely to the volatilities of the elements of the portfolio. Jumping back over here, we'll take a quick look at crude oil. So if we do CL equals F and we do a weekly data pull, and let's go back 20 years to start. Refresh. Okay, sort by length. This 271 week looks pretty strong. 82, 83 Bartels, strength 2.23, although this 145, which may be a harmonic. It's, not too far off half of that one, right? So bearish on the longer term cycles. A little lingering bullishness from this one, but getting long in the tooth, right? But this 145 week, which seems to be kind of the strongest, I bet that's this one right here. Yep. Green triangle, steep sides, right? That's a sign of strength. You want to see good definition between your cycles if you can. So that's a really solid cycle there, the 145 week cycle in crude oil. Definitely bearish. And then we can jump over to the daily.
Richard, just a quick technical question on
Yeah.
the buzzword Bartels. So it's, of course, here at the FSC, we know the meaning and it's used regularly.
Yeah.
But for those who are hearing it for the first time, could you briefly explain?
Yeah, the Bartels is a test of statistical significance to, it's a statistical test to say, what's the likelihood that this is not an accident, right? That this is not just curve fitting. So the higher the Bartels, the more confidence you have that this is a real cycle that is matching the data well and has done so for a considerable period of time. So it's a test of statistical significance. All right, so jumping back to just a analysis of crude on a little shorter time frame. 164-day cycle, 90 Bartels, highest strength 4.62. It's a great cycle. It's getting close to bottoming, but still on its way down. And then if we want to do a shorter term analysis, say 18 months, refresh. What do we got? Probably the 90-day cycle, still bearish. And going a little shorter, any good cycles down here, 21, it's pretty short, but we can look at it. Looks like the 21-day cycle is getting kind of run over by the longer term cycles right now. So overall, crude still looks bearish. All right, well, Ron, I think we'll leave it at that. And again,
and on that,
the presentation will be available for people to view again. Overall, just want to emphasize again a couple of things. But were you not seeing my screen when I did that?
all clear, visual and audio.
Oh, you are seeing it. Where did I put the controls? Yep. Okay, stop share. There we go. All right, so I really do think that we're in a sea change economic environment where we've had an artificial wealth effect engineered by central banks and governments. I think that's clearly visible in the ratio of total net worth to GDP. We've seen that really diverge, right? Net, wealth growing, even though the economy isn't more productive. And that's not normal. And I think there's going to be a price to pay for that. And I think we're starting to experience that. I think we're probably in something like the 1973 market, which I think is going to be, in terms of stocks, up to a 50% correction over 18 to 24 months. And I think that, it's one of those times where, people could just start selling everything, right? So it is a dangerous time. It's a time to survive, not a time to try to be a hero. And I think that we really need good indicators like the cycles technology, but we also really need risk management. And we need to position ourselves in the markets so that we can still sleep at night, but we can also be involved. So hopefully between the cycle analyzer and the RiskSmith app, you now have the best of both worlds, some excellent timing indicators and trend indicators, and some good tools for risk management and risk analysis.
Thank you, Richard, for a wonderful presentation and follow-up insights with the Q&A. And I just got word that we have a nice surprise from FSC board member Jake Bernstein, who's here live just for a few minutes to say hi to us, the audience, and maybe a few words about his presentation tomorrow.
Oh, wonderful.
Oh, thank you.
Hello, Jake.
Is my mic on?
Yes, we got you.
Oh,
We don't see you, but we do hear you.
Thank you, Richard, for a wonderful presentation.
Thank you, Jake.
You were hired to run the Cycles app. It's my
And Lars, but and Jake, do you remember meeting me at that conference 25 years ago and telling me the winners don't need the money?
Absolutely. I think I also told you that in order to make money in the markets, you have to not care.
Yes, you did.
The more you,
Similar thing. And you told me the story about talking to the cattle ranchers as a long-haired hippie Jew
that's
down in Alabama.
that's certainly true. Certainly true. It's a pleasure to be associated with the foundation, an honor to be on the board. And I would have to say that every board member and every associated person can easily find a 6 or 7 figure job somewhere else, but we continue to be dedicated to what the foundation does. And it never ceases to amaze me how the cycles continue to plod along in spite of what governments do, in spite of the upheaval that's going on in the world. The cycles continue to plod along, as Dewey said, the mysterious forces that trigger events. And as you all will see tomorrow, when I do my presentation, which is a continuation of what I showed at the last summit, these cycles have been true to form. They just continue to perform extremely well, with some major changes coming over the next several months. For example, a significant long-term cyclical low in the Japanese yen versus the dollar, some significant cycle lows in platinum and palladium, all of which I can't really extrapolate what it's going to mean in terms of society and culture and history and geography, but it's definitely, we are definitely due for a major change. And I appreciate the opportunity to do that tomorrow.
Really looking forward to your presentation, Jake. We so appreciate your support and board representation and all your presentations. It's great to have you. Thank you.
Thank you. I appreciate that. It's the least I could do since when I walked into the library in the summer of 1972, searching for a way to trade, and found the Cycles magazine and read it, and I was bowled over and just blown away by what was in that magazine. It has absolutely changed my life, made me a wealthy and healthy person and a wise person as well. And I want to thank everyone here for being part of the board and part of the support. So I will see you all tomorrow, and I thank you again.
See you then, Jake.
Bye-bye.
All right, Ron. I think the floor is yours.
Thank you.
Thank you very much.
Quickly share screen.
Signing
Thank you.
off.
Okay, so a follow-up welcome as a speaker now, switching hats to share what is themed Roadmap Cycle Insights, and that's both as a market strategist, but also as part of the FSC team where I serve as development director. Some of you may recall a debut presentation that I hosted along with the FSC Summit on economic cycles and how they correlate to sunspots, if you look at the decennial, and various other insights that I shared there. This is market specific, so I won't be going there today, but if you're interested in additional alternative insights, do look that up on the FSC TV. Topics for today: roadmap cycle insights, which basically highlight asymmetric risk for the second half of this year, going into 2023. Global ranking model in terms of best and worst trends and how they fare across different markets and timeframes. A piece on seasonality trends and how they're realigning, but in a 3-stage process. I know seasonality is a big focus of Jake Bernstein, so I'm keen to share his views tomorrow when he speaks. And then as a follow-up in the second section, more macroeconomic focus and how that's driving markets into this new heightened regime of risk. Inflation proxies, how they're unwinding, and the likely historical rhyme with the 2008 global financial crisis in terms of deflationary pressures that are taking off right now. Now, in terms of specific market charts, I'm keen to double up on what Richard was sharing there on the Cycles app on equity markets in particular, and I will feature the S&P 500 as part of what has been termed a Minsky crash pattern ahead in past work that I've published and now updated. So I just want to give you the key tactical overlays, but then also just give you an idea of the risk scenario to the downside based on that pattern. Eurodollar, just to look across the ocean to where many of you are actually already registering from, and what that means in terms of further pressures in that region, and the currency itself. As many of you will know, Eurodollar is now at parity and breaking down from a near 40-year trend. And then finally, a few words on scenario planning. This is an area that I've been focusing on in recent times. It's not new, but it is being renewed in terms of its importance in how it can help reshape our market and mind strategies during challenging times. So there are some of the key insights I want to share with you in the time allocated, and I'll do my best to pace. Please ask questions throughout, but more than likely I'll need to get to the questions right at the end. So roadmap cycle insights, asymmetric risk into the second half of this year. I love cartoons because they bring good humor, light energy, but also they allow us to think outside the box from time to time. And you can see here on the left, the bull debating with the bear which way the market will go. But essentially the elephant in the room is the cycle. And as cycle enthusiasts here at the Foundation Study of Cycles, this is so true. And I really appreciated Jake's point about how cycles continue to stand the test of time despite so many exogenous influences, whether it's artificial market factors, central bank policy, socio-political headwinds. In the end, it's all part of what we call the cycle, or the elephant in the room, as this cartoon suggests. Now, the framework that I apply is top-down, looking at a tried approach of macro, fundamentals, and technicals, primary focus on technicals. It's something that is framed as behavioral technical analysis, which is something I'm quite keen on in terms of the animal spirits that drive markets, and how by studying the behavioral patterns, we can truly understand not just markets, but the world that we live in. That is used within a blended approach of quantitative and qualitative indicators. And then you can see the yellow circle on the bottom right, focusing on cycles with a roadmap model, which includes business cycle and seasonality patterns. I'll share an important point on seasonal patterns in a moment. And then trend ranking models, global markets, multi-asset sectors, and stocks. I'll share with you the latest output of what's trending best and worst. This is the matrix of business cycle stages in a traditional cycle. And you can see that the top half looks at macroeconomic from top down. So you can see macroeconomic here, fundamental valuations, and then technicals, which all provide guidance more for the long-term investor in terms of asset allocation and style of strategy. But essentially what it suggests as part of this traffic light process of an economic market cycle is that we are late stage going into recession. So that means that on the macro growth numbers, growth has peaked, as we all know, is now losing momentum and starting to approach negative territory. Depending on which markets you look at, but US is a case in point. Valuation continues to unwind from extreme levels. Some value investors are calling this a good place to buy in terms of the value opportunity at cheap levels. But us cycle enthusiasts and technical analysts are also concerned as to whether it's catching the falling knife, and whether there is still more of a bear market ahead. And technicals continue to deteriorate based on many different measures, including market internals, market timing, but also just the general deterioration that continues. I will preface that we are likely to see a midsummer rally in July, and that's the key insight I'll share with you on the seasonality analysis. But just to stick with this long-term big picture, it suggests portfolio de-risking, capital preservation, potentially quality government bonds, and then later on corporate bond yields if and when we get into a riskier situation. And in terms of currencies, US dollar for now, although you saw there on the Cycles app, that might not be for long. The trend probably won't be your friend for that much more. And the currencies of choice will likely be Swiss franc, according to my analysis, and I'll share with you that chart as a special feature right at the end. And then for those investor equity professionals, think about large cap growth for some of the stronger balance sheets and dividend yields, and then some of the defensive sectors, which continue to provide some safety. Gold is also likely to be a good portfolio de-risker in relative terms, but not in absolute. As we can see, there's a breakdown happening in gold already, and the Cycles app was also suggesting further downside ahead. If I could just get a few yeses in the chat or emoji thumbs up, just that everyone is clear on this one slide, because I did share quite a few points there. I just want to make sure that's okay. Thanks, Mark, and Agnes, and so on. Inverse equities is if you were looking to short the market. So that's an ETF that could be considered for that. There are some people that are actually starting to look at ETFs that could actually make money in a falling market. And so short ETFs is one idea, and that's why it's on this slide. Of course, it's worth looking at the column ahead, recession, in terms of what would be the recommendations, and there's inverse equities along with corporate bond yields. Okay, now the roadmap investment cycle is a model that was developed by my mentor and friend, Robin Griffiths, with about 50 years market experience. And essentially, it is a blend of economic and market cycle framework. It has a asymmetric shape to it in a traditional cycle with a fractal pattern. It looks like the Elliott wave pattern, but it is not. You can see that the labeling is different. And that is a discussion I know that Robin and Bob Prechter had back in the day when they were sharing their models. Plus, there are different variations of the same model depending on if the market cycle has a bullish or bearish skew. And what it suggests right now is that we are in the late cycle stage as per the slide I just shared with you in terms of the business cycle rotations. And what it meant in terms of macro fundamental technical here, it shows that we are between this area of W, X, and Y. And this is a good visual schema for the patterns that usually play out. Market cycle transitions are not overnight events. They are traditionally a process. And according to this chart, a three-stage process, which is a fall, rally, and rest of fall. And the middle part of that, the rally, is deemed a sucker's rally, where we usually get significant bear market rally reactions, which later on fall from grace and just create a deeper, stronger landslide. So that's just a visual cycle schema just to kind of use as a reference. Now, that cycle roadmap is based on economic cycles, and these are many of the cycles that I hope that we can feature more eminently on our FSC website and as part of our FSC education, which will be developed in the second half of this year. You can see here from top to bottom the big cycle labeled Kondratiev wave, which is 46 to 60 years. That influences interest rates, but also general disruption and commodity pricing. The jugular cycle, which is more in line with the economic cycle and can sometimes coincide with the decennial cycle, that averages 7 to 11 years, but an average of 10. And the kitchen business cycle, which originally started in the United Kingdom, but later on got exported to the US and became part of the presidential cycle, which is very important this year, given that we have a midterm coming up soon, which will naturally influence policy, but also market sentiment. And then last but not least, the baby cycle, seasonality. Needless to say, sell in May, and go away did work this year. I know it hasn't been so reliable in past times, but that's because we've been in a linear uptrend fueled by central bank liquidity and sentiment extremes in terms of FOMO, fear of missing out, rational exuberance. And clearly that party is coming to an end. And so for that reason, many of these cycles are realigning. The beat is back, and seasonality is a case in point. Now, there's a lot of backtesting and statistical analysis that I like to do in the background just to make sure that there's a good mix of qualitative and quantitative methods in order to improve the robustness and reliability of these cycles. It is part art and part science. That's why there is no kind of holy grail output, but certainly useful to use a mix. And you can see here, based on spectral analysis, if we put all of those economic cycles into the box, the one that is most robust is the jugular 9 to 10-year cycle, but also a 20-year cycle, which I haven't featured. It's one that Ray Tomes, the head of the science and nature department at the FSC, is quite keen on, and we often discuss its importance. If you combine jugular and Kuznets together, you get this sine wave curve, which is predicting growing mean erosion risk for the second half of this year going into 2023. I've got lots of other cycle models predicting, different directions on different markets and different data sets, but I've only included the ones that are meaningful to this presentation for now, and we'll share the rest later in a future presentation or as part of FSA publications. But just know that here and now, this is definitely most important for the second half this year. Now, if we segue from cycle framework and the predictions that it has for the second half this year, I'll briefly share a global ranking model and what it suggests for best and worst trends and the story that we can derive from it in terms of investing and trading strategies. So this is just a basic global ranking model driven by momentum trends. You can see here from left to right, long-term strategic, medium-term tactical, and short-term active. It's color-coded based on a cross-asset mix of markets. And the story is that there's an inflation unwind. You can see that US 10-year yields is falling down across the different cycle trends. That also includes copper, which has had the biggest pain trade in the commodity sector, and oil is slowly but surely starting to reverse as well. It failed to break above its peak highs at 125, 130, despite ongoing geopolitical tensions vis-a-vis Ukraine and Russia. And it's now starting to follow a potential peak in inflation, deflation ahead. And what we see here on the equity market mix, China and India is top. China actually was a good buy in May and hold up until the 200 moving average. I'll share with you that chart in a moment. India is on a stronger footing after 3 consecutive months down. And so you can see there, Asia is starting to show some early leadership, but likely temporary as part of a bear market rally that will fizzle out in the second half this year. It just shows that Asia is faring better on a relative basis. And then you can see USA underperforming, although it's holding at the June lows, and Europe bifurcated with Germany down and UK up. Okay, so that's the general mix based on the global ranking model. Now moving on to seasonality and what key messages we can learn. Seasonality trends realign, but as part of a 3-stage process. And the second cartoon, which I found just recently, lovely humor, sell in May and go away, shouted at one investor, and the reply is, nah, not gonna happen. But of course, this year it did, and it's a good time to gloat and see the cycles coming back. Particularly this one, because it's actually proving quite useful. Now, if we look at the evidence, the statistical testing of seasonality trends going back over 100 years on the US equity market shows the ebb and flow of stock market performance, which does actually follow a sell in May negative seasonality pattern. It peaks out in after March into April, following the Q2 earnings season. If earnings is positive, then usually there's a peak in optimism, which then sets up the mean reversion move down into May. So there is a sell in May effect, but the worst of the downfall of the SIM pattern, sell in May, SIM, is not May, it's June. And thereafter, the bigger drawdown to come is September, not October, which many people remember as the anniversary fall crash month. So note down, June and September are your worst performing months of the sell in May pattern. And in between, typically, we do get a midsummer rally from July into late August. If I could just get a few yeses in the chat that is clear, useful, and that maybe some of you can note that down for reference. It took me years to actually clarify this, test it, and put it to use. Great. You'll find these charts available on the FSC website within the blog section. It is a blog that I did write. I can try and share that with you on the chat. But of course, if you just go to the website, you'll find it there with more context in terms of the write-up that I did just recently. Okay, now what's really interesting is not just the sell in May pattern, but the month that just passed. June this year was the lowest return in history. We heard their FSC chairman, Dr. Richard Smith, say that the year to date, the first 6 months of this year have been the worst ever, but also the month of June has been the worst in history if we just single out that month. And that does fit in with the traditional seasonality pattern. But what's most interesting is we broke the records of past negative June months, which include the 2008 global financial crisis and the 1962 Kennedy slide, which followed the Cuban Missile Crisis. So there's an interesting historical rhyme of both time points there. But what it does suggest is not just that there's a historical rhyme, both in terms of markets and event risk, but also an increasing probability of a bear market rally from these extreme oversold conditions. If I could get another yes in the chat that's clear. This is highlighting historical rhyme in terms of market and event risk. But more importantly, for those of you who are looking for the trade, it is the increasing probability of bear market rally from oversold conditions. Now, I was checking my social media feed and looking at various market expert reports and found an interesting call from who we know now as the Big Short, Michael Burry, from the movie that many of us would have watched, about one of these smart minds that managed to short the market at the right time. He was a little bit early. His clients were very frustrated at the time, but he is billed in history as the Big Short guy that did call the market despite all the odds in terms of what was going on in the housing market and central bank policy. What is he saying now? He's saying that interestingly, bear market rallies during a bear market crash usually exhibit the largest one-day rallies to the effect of 10% as a low bear market rally and an average of 23%. So we can really have a significant bear market rally, which would not be a sign of a new bottom that's in and a bull market ahead. It would actually be the suckers rally that would, basically take further long positions out to the cleaners in order to slam us back down again into what will be an elevated volatility environment with further liquidation patterns, which obviously is what makes a bear market so difficult. So this happened last in Y2K, the tech bubble of 2000 and the great crash of 29. You can go back in history and look at other examples, but they're the ones that he highlights. Now, if you look at the chart of S&P 500 right now, with basic mathematical regression bands. It shows potential deviations that the market can make. So price swings up or down. And you can see there the equilibrium based on this dynamic equilibrium is at 39.50. The top side is 4,200, which would be a minimum price objective. I mean, if we break above the peak levels of 41.30 and the 50-day average, which is hovering nearby, then 4,200, which is the top side of the channel, a move to 44.21 would be a best case scenario, the 200-day moving average, and that actually equates to approximately 20 or so percent bear market rally. So we could, if we had a move all the way up to here, this would fit in with the Michael Burry thesis of what happens during a big bear crash, as is likely happening right now. And whether it is or it isn't, it is something that we should at least factor in. And if I could push you all just to, again, for a few yeses in the chat, just to make sure that this insight is clear, that would be good. Thank you, Jeffrey, Lokesh, Amos, Chris, and Johnny. Okay, great. Because this is important, clearly, in terms of the potential implications of this, but also the timing. And of course, if we break the June low, all bets are off for Midsummer Rally, and we just continue to extend. I'll give you the risk side of the scenario later on in the discussion. Now, what's interesting is if you look away from the US, which I know is difficult because we are so West and US centric, it is where all the trading and liquidity is. And psychologically, we have this leash effect with Western and US markets. I just came back from Asia, where I was living in Hong Kong, had a lovely experience there. But I also got to see and experience how the world looks from Asia and from investors that trade in Asia. And so when I was speaking to many of my Asian colleagues just recently, they were telling me sell in May and go away. China market's up, and it's up in a big way. And you can see here the China market is actually up to nearly the 200-day long-term average. So it actually fits the Michael Burry bear market rally thesis, but not in the US, in China. And again, China will still be hit hard by a global recession and any kind of big market correction or crash. But you can see here how we have maybe a forward look into the future, but not in the West, in the East, looking at China and how it's actually been a buy in May, not a sell in May, and it's retesting the 200-day average and has had a significant bear market rally already, but will likely fall like the rest of the world markets will too. Now, as and when we do get the fall, this is the most robust part of the seasonality pattern, and that is in September and October, as I alluded to before. And you can see there this chart, which is an average pattern based on statistical testing of the autumn Q3 fall crash cycle. It starts with the midsummer rally from July, as I mentioned, but into late August, early September. The numbers on the bottom of your screen are calendar dates. You can see that's the 25th of December. This is the, I believe, close to the 10th of September. So you can be quite precise of the days or the weeks. But essentially, you get a peak out or a technical divergence that happens, and then you get the landslide down. The worst drawdown is in September, not October. Usually we get a false low in September and a true low in October, and because the absolute true low in October is what we remember, we continuously think that October is the worst of the worst, but actually it's September and October. So that'll be useful for those of you who are looking at more of the shorter term timing of things. But generally speaking, September, October is well known to be heightened volatility and will likely be even more this year, given the asymmetric risk that we're seeing right now. So Ray, good point about the 1% fall. Yes, so this is looking more at the price pattern as opposed to the actual percentage move. So good point that Ray's making in terms of the actual percentage scale. So yes, this should be more about the pattern itself and not the scale. So for the purposes of referencing this, that the pattern is key. The scale changes according to the data set that you add in. And of course, it's not a one size fits all. There are going to be variations of this from one cycle to the next. But more than likely, we will get stronger downside risk, which will potentially happen faster than this suggests. I've received a few emails from FSC members that read this article, and they were overlaying this cycle with other cycles and suggesting that August could be the negative month. So time will tell. But thank you for those emails from those of you that have sent it through. These are standalone examples, but of course, once we correlate them to other cycles as part of a fractal approach, as Dr. Richard Smith highlighted, of course, you will get slightly different results. Okay, and let's shift now onto macroeconomic proxies, specifically inflation. Of course, it's all part of the market story. If there is a peak in inflation, then that would likely signal recession warning and a potential deflation situation, as was the case in 2008, and that would be the historical rhyme. And what's interesting is most people are screaming inflation, 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 because on a day-to-day basis, that is what we see, whether it's food, energy, or other. But if we look at the chart as our real-time feedback mechanism, you can see that inflation proxies are topping. And that's actually the same evidence that we saw looking at the Cycles app that Dr. Richard Smith was featuring, where I believe he saw a top in 10-year yields and a bottom in notes, I believe. He can correct me if necessary, but also a downside in risk in commodities. And we all know that to be true because, of course, that's where the pain trade has been so far. So if we just follow this chart mosaic from left to right, following the number inserts, figure 1 is US 10-year yields breaking the tactical 50-day average, which has been holding strong year to date. And that would be a significant breach if it continues, at the very least to the 2% level. Inflation break even has collapsed. It actually peaked in March of this year and landslided from May to June. So a lot of important breakdowns that have happened in the last 2 months. Commodities, looking at this chart, that's a CRB, which is a mix of energy, agricultural, and metals. And you can see that peaked earlier on late last year, but the downtrend has extended below an important support line and is now a bearish top breakdown. Oil has a short-term reversal after failing to break above its peak levels at 120, 125, despite ongoing geopolitical tensions, Ukraine and Russia. So you can see it's lagging the commodity pain trade, but it's still responding just at a slower pace, given all the risks that are propping it up. And then last charts on the right, F5 and F6, you can see copper is where the worst of the move has happened, and a bearish cross has formed between the long-term and the medium-term averages. And then F6, soft commodities, where the big fall happened. Yes, we did have a spike in food prices early this year, but that peaked out since and is now below the long-term 200-day average. Now, if we look at the potential historical rhyme of deflation and global financial crisis events that have passed, here we can see on the left side what has happened so far. You can see copper, industrial metals, agriculture, and oil down. They are all clearly rolling over, copper and industrial metals more than the others, with oil to follow. And in 2008, we saw a similar move, but a much bigger collapse thereafter. Deflation historical rhyme, question mark. I'll leave that for all of you to consider, but certainly this would catch out a whole lot of inflationists right here and now that are still screaming inflation. Maybe inflation continues to be strong on a long-term structural basis, but nothing moves in a straight line. We know that from cycle framework, and right now the charts are saying that there's a change, there's a top, and it's rolling over. Inflation is transitory for now, and that is likely signaling recession ahead as global growth turns negative. and technicals continue to deteriorate. Now, I'm going to complete the presentation full circle back to what I've termed the Minsky crash pattern that was originally developed by a US economist, Hyman Minsky, describing a macroeconomic bubble environment, which is fueled by low interest rates and speculation, along with other factors, and basically explaining what triggers the bubble burst. So I decided to repurpose that that framework, macroeconomic framework, onto a chart to add the technical dimension. So I'll share that chart with you for more practical strategy in a moment after this following slide. First, I want to just paint the picture of how low can the market go based on the recent bear market correction from the flash negative performance that we had in January, which really was the January barometer effect for the rest of the year. We can see here, first of all, if you look to the left of the chart, pre-2022, markets were linear. We had less than a 5% correction for more than a year. Buy on the dip worked 1, 2, 3, 4, 5, 6, and 7, almost 7 sequential times. You would make money just by holding or buying the low. And so that definitely conditioned us in many different ways. FOMO became extreme. And when things changed after the peak out and then a bearish moving average crossover, the 50-day and the 200-day, which was your strong bear signal, it wasn't buy on the dip, it was sell on the rally. And so many investors and traders that I'm speaking to are still finding it challenging to do that switch. And really going back to Darwinian thinking and the whole edge in evolution, it's not about the most sophisticated strategies that we apply or the most robust, because at some point they will fail. What matters more is how we can adapt and respond to a changing market environment. And this is what a lot of professionals, as Richard was saying, experienced and new, are finding so difficult, because it becomes a new mental map that we need to reshape during this changing time, not to mention all the event risk that is taking place. So I'm sure many of you are making that change for the better and readapting and responding to the new conditions. And if you are, the technical levels are to the downside are down at 3,500, the 50% make or break level of the rise from the 2020 pandemic low. But more importantly, the pandemic peak gap, so the pre-pandemic peak gap at 3,400, 3,260. Mentors of mine have always taught me that markets are driven by animal spirit, but ultimately animal spirit has a memory, price, and time. And that's partly how anniversary dates and cycles work. And so certainly going back to 3,400, 3,260 is going to be key, not just as a technical level, but as a moment in time that the collective remember that the market topped and will likely magnetize trading for some time. If we were to break below those levels, particularly the 66% level at 3,100, that would be a primary trend reversal signal for the entire trend from 2020. You'd have to go back further if you want to go to 2008 lows to also apply those structural levels. It's a combination of Fibonacci and Dow theory levels, but just to keep it simple, the line in the sand is at 3,500, then 3,400 and 3,260, and then most importantly, 3,100. Of course, you can trade into each of those levels as a short-term trading opportunity, but most importantly, look at the structural relevance of these levels, because that will signify continued breakdown ahead. And of course, if we don't punch below those levels, then expect consolidation and a potential relief rally to come. Now, the worst case scenario is based on this chart, and this is the Minsky crash pattern, which, as I mentioned, was originally developed by the American economist Hyman Minsky, based on a macroeconomic bubble environment that bursts due to various factors. I have repurposed that for on a market proxy so that we could have a technical framework for practical strategy analysis. And you can see here, it's a 6-point pattern as part of an expanding wedge shape. And what it shows is a sequential higher peaks and lower troughs. So this ongoing wrestling match between buyers and sellers, demand and supply. And what that produces is self-feeding volatility. You can see here, as the swings get wider, so does the volatility. But the issue has been this linear move to the upside with minimal volatility, which creates the big negative skew to come. Now, the top in the pattern is 0.5. That's when we reach excesses in terms of behavioral sentiment and liquidity. Then 0.6 is when we get the rollover, which is ultimately the kiss of death as long positions get liquidated, and then we start to get fear and panic settle in. We haven't had the panic yet. That's yet to come. Fear or denial is where we're at now, and that's why I was asking the question to each of you, what stage of the cycle you thought we were in. Clearly, if we break below the pandemic gap level at 3,400, 3,260, it suggests further downside to come. There's a slide that I show with you right at the end that will give you a good, bad, and ugly scenario, which each of you can explore. This, I think, is the beauty of cycles, because it allows us to remember that there's a sine wave both in markets and life, and that nothing moves in a straight line up or down, but then also that there are alternative scenarios that will develop with each cycle. And so I'll put that question to you right at the end of this presentation, just to survey and see what our FSC collective are thinking. As a final market chart, for many of you looking at currencies, but also macroeconomic indicators in the FX world, Eurodollar is key right now, as it hits parity for the first time in a very long time at 20-year lows. But actually, if you look at the long-term chart from the Deutschmark days, it's a near 40-year trend breakdown. And in a moment, I'll share with you a crisis pattern that would have helped you predict that breakdown with cyclical analysis down below. So what's interesting is if you look at sentiment surveys based on smart money, financial institutions, sell-side banks across the board, all showing divergence on the Eurodollar trade. And a big question I've been asking is this intelligent groupthink or a pain trade ahead? And history has now passed, and it is proving to be a pain trade that a lot of people got wrong, because the worst case scenario that smart institutional experts were predicting was 104, no more. And actually the mean was 114, and the best case was 132. And that actually had a reasonable predictive outcome here, as you can see within this probability distribution. Now, if you just look at the charts, and I'll share with you later in the next slide the cycles that come with the charts, you can see that Eurodollar was already in a 20-year trend breakdown, and clearly that tidal wave was going to win out at some point, particularly at this make or break level at 104. If it did hold, then that would be an interim bottom. If it didn't, then that would be a parity inevitability, but also a target to 91 as a traditional trend channel objective. So that's Eurodollar case in point in terms of the tidal wave that has been driving it down, the make or break level that ultimately did break, and how that would have actually helped you make the pain trade that many people were on the wrong side of, based upon this chart. Now, my pride and joy is this chart, which was a struggle to get the data on. I hope that we can, as one of the unique value offerings we can share with our members is more market data. I know we have a library of market data going back far back into history. And if you just go back to the 70s on Eurodollar, including the Deutschmark years, you will unravel some very interesting insights. First things first, this historical rhyme, what I later on called a crisis pattern, based on macroeconomic trends, but also price patterns. And you can see here this two-stage effect, which averaged out 91 months to the upside during an economic expansion, and then a corrective breakdown thereafter. What transitioned the first cycle was the ERM crisis of 1992. And then later on, we had a price symmetry or price symmetry variation with the global financial crisis of 2008. The trend, which was also part of an economic expansion then, was slightly longer, 93 months. But the downtrend thereafter, which I highlighted to you just now, the 20-year trend, did hold true, and ultimately just recently broke a 36 near 40-year trend support. And that fit in with some of the long-term cycles down below as part of a 16-year and 4 to 5 year, 16-year long-term and 4 to 5 year interim. These cycles also overlay on other currencies, but primarily on the Eurodollar major currency. What's most important about this is, of course, from a trading point of view, it suggests further bearishness for the European region. That also makes sense in terms of the geopolitical tensions between Ukraine and Russia and how sanctions are negatively impacting countries like Germany. We're seeing that in economic numbers, but we're also seeing that on their markets. Investors and traders are now voting with their feet, and you can see that the German DAX is down significantly, and Eurodollar, as a case in point, is deteriorating more than any other currency out of the majors. And so as part of a currency debasement effect, this is a race to the bottom, but Euro is losing the most, not the dollar, although of course the dollar will likely have its last stand soon. Eurodollar is underperforming the most and will continue to do so. And then just a final overlay on the same currency, looking at alternative chart methods like point and figure. You can see here price projections suggesting a move down to 97 as an extended target. Potential risk scenarios as part of these kind of black swans that I like to annotate on a regular basis. Big cycle risk into the second half of this year, which would be the economic contraction that would be further headwind on Eurodollar as part of that crisis pattern that I just highlighted. Geopolitical tensions that are already here and will likely continue, especially in the winter season, as many Europeans look for heating oil. If Russia closes the tap, that will heighten socioeconomic risk and likely further market pressure. And of course, a debt crisis ahead, time will tell as and when that may happen, but certainly that's still something to consider. And the slide here just showing you that composite cycle predicting the risk ahead. And now, on a lighter and more positive note, if you're looking for a last safe haven currency or market in general, I would put it to you that the Swiss franc is the one to look at. And if you see the charts here on the left, dollar Swiss and euro Swiss are pointing to Swiss franc outperformance. So when this chart goes down, you're seeing Swiss franc outperform. And in terms of dollar Swiss, it's multi-year pattern breakdown under 87 and 83 support levels, and euro Swiss parity risk ahead, not parity euro dollar, but parity euro Swiss in favor of the Swiss franc. And there's various related proxies that are also suggesting that, including rising dollar Swiss hedging costs, which could peak out and suggest further upside to the Swiss franc, along with correlations with yields, which will continue to dislocate in favor of the Swiss franc. Okay, so final words to end my presentation on Roadmap Cycle Insights is on work that I'm doing on scenario planning. And I believe this is part of the cyclical thinking, both in terms of strategy and in terms of our behavioral tendencies. And the opportunity here is to reshape our maps of the territory. And cycles, I believe, truly can help us reshape maps of the territory because they give us a kind of a blueprint DNA to both market rhythm and life itself. And I think in there lies both, the market benefit, but also the life philosophy that is cyclical driven. So on that point, a few words on reshaping your map of the territory. A word of support for maps and models. They are useful guides, but as we can see in this blind elephant cartoon, which I shared with you at the end of the FSC Science Summit presentation that I gave on economic cycles and sunspots, all of this wonderful research that we all do as enthusiasts and as market or science professionals is great and important, but it's only ever a reference point and never exactly the real thing. And so I'm hopefully speaking to like-minded people here, as many of you will have years of experience and know this to be true. You heard Richard say 20 years, other even more than that. I've been approximately 20 years too. And then throughout that time, we continue to learn. And the key learning is that in addition to the map is not the territory, and we always need to reshape our maps, there is that there are only probabilities, not certainties, in predicting market outcomes. And a large part of scenario planning is discussion, challenging, sharing different perspectives, maps, and models. And I think this is really important during current disruptive VUCA times where markets are volatile, uncertain, complex, and ambiguous. It's really important for us to focus less on prediction and more on preparation and in scenario planning for each of those potential scenarios that can take place. That allows diversity, which helps avoid biases and linear thinking, which I think is part of the cyclical framework in itself. And just that point on preparation versus prediction. Prediction typically is reliable during short-term time horizons, although of course there are exceptions. Low volatility environments help prediction. Of course, the exceptions are trend cycles or big booms or big crashes that can be cyclically predicted. But what enhances the whole process, whether it is strong or not, is better preparation through risk, money management, and scenario planning. And I think that was something that Richard was stressing on in terms of safety first and survival in the current markets. And so try to avoid only applying tunnel vision, which leads to blind spots, and focus more on lateral vision, which is more strategic and allows us to ultimately reshape our maps, not just of known knowns, but known unknowns and unknown unknowns as part of the real value in scenario planning. And here's a case example that I will leave you with as a wrap to my presentation. Good, bad, or ugly, green, yellow, or red. These are the three bear market scenarios that can take place. The good is a V-shaped recovery. Maybe we have a midsummer rally that continues back to the record highs, and we can all forget about the bear market ahead. Bad, a U-shaped recovery, which will have an average of a 50% drop in terms of price magnitude, but in terms of time repair and recovery, 1.5 years to 3. Or an ugly situation, 1970s, you can see there figure 5, which had more of a roller coaster ride, price swing situation, looks like a heart attack, where we have worst case 50% down, 70% up, and on single stocks, it's really crazy. I remember Dr. Smith saying that we could have a 1970 situation based on his thinking. It'd be interesting to hear what many of you are thinking. And figure 6, the worst of the worst, and it needs no introduction. You'll probably need to have a strong drink of something strong. The Wall Street crash, which was the waterfall slide of close to 90%, which, by the way, had a V-shaped recovery in the early stages that later on rolled over the other way. So what do you all think? Sergey saying should be V-shaped back to roaring 20s. There we go, with a heart-shaped emoji. Dina saying optimism is the American way. That is why we buy the dip. Love it. Strong optimism and a big shout out to passive investing. Alante, Kondrativ wave tells you which one it is in terms of the Kondrativ. Dina saying all should go up, so you can be market specific here. I'm looking at equities and just global cross assets as a mix. Bobby saying long term, Lokesh couple of months at a time. So maybe this is something we should wait and see. Brad is saying I'm going to need a drink. There we go. I'll look forward to having a virtual drink with you, Brad, and hearing your interview later on day 3. James, we now print money, so not 1930s, so a different situation. We could have yield control, perhaps. I've heard that as a 1930s analog. I know Ray Dalio is big on that, along with other hedge fund managers. Mary is saying Fed will intervene not to allow 1929 to recur. Sybil, 1970, Biden is likely Jimmy Carter. There we go. Agnes, 1929, next year will be ugly. Amos, this is going to be either bad or ugly. Dina, a drink sounds good. There we go. A big call out to our event organizers to organizing an in-person event at some point where we can do that, socialize and have fun. Bob is saying a mirror 1973 to 74, which is this move here. And Bill, long-term trends confirmed. Johnny, figure 2, figure 3. Which is the 87 crash and the 2008 global financial crisis. And Dina saying, I love animal spirits. I will consult with them. Yes, always a good thing to do when you're able to make the connection. David, the new USA dollar will have the buying power of $1955. Chris saying, asked me yesterday. William, it will be whatever hurts the most people. I like that. Sergey, you can do a Zoom poll, maybe something for next time. I can try and do that tomorrow. And then the discussion continues from Agnes, Michael, Ralph. Thank you, everyone. That was a whirlwind discussion. Quick correction, Brad Rotter is tomorrow, not day 3, so please look out for that. Thank you very much for the positive feedback from all, Mark, Johnny, and many others, Caesar. And I shall wrap up on final points. Roadmap cycle insights, asymmetric risk for the second half of this year, global ranking model highlighted inflation proxies unwinding, commodity pain trade, but also a rotation between East and West, where China and India is top as part of an early bear market rally that will still roll over, with Western markets still to begin their pattern in mid-July onto late August, with September and October having their biggest drawdowns. Seasonality trends realign, but as part of a 3-stage process. Just to be clear about the 3-stage process, it's down in May and June, up in July and August, and then the rest of the fall down September and October. That's the 3-stage process that I was alluding to. So it's not a linear move by any means. Minsky inflation proxies unwind. We can see that both in US 10-year yields, inflation break-even, and many of the commodity markets, particularly copper and agriculture, soft commodities. Minsky crash pattern ahead. I highlighted some of the technical levels, but also some of the big picture patterns. Eurodollar crisis pattern as part of the Europe underperformance that will likely happen, which is also likely going to be pressured by the geopolitical tensions. Listen to the comments of Andy Pancholi on that, who's our resident expert on geopolitical cycles. And then finally, scenario planning, focus on preparation in addition to prediction in order to help reshape your cycle map of the territory so that we can better adapt and respond to the changing environment, both in terms of markets and life. Thank you very much. It's always an honor and a pleasure to speak on behalf of the Foundation Study Cycles, but also be part of the team as a development director. And again, I welcome all of the lovely feedback that we've received from you today, emails that I get here and there following various things that we send out. And if you have any questions, please continue to send them through on ron.william@cycles.org and visit our website for more information about the FSC. I will stop there for any final comments or questions. Happy to invite Richard and the team for any comments that each of you would like to share. Agnes asking the question about euro dollar. Will that stop? Will the correction stop? And the answer is it will likely extend lower based upon the pattern. The chart that I shared with you is not the updated chart, but if you can get hold of that chart, I will likely feature it on an FSC blog. Then you will see that there's further downside. So the target that we had is at 91. That's the bottom of the 20-year trend channel, and the cycle is still down. But remember, we also have a race to the bottom as part of the currency debasement effect. And we just saw the cycles app that Richard featured early on, showing that the dollar is likely going to have its last stand. And I shared with you right at the end that Swiss franc is likely the last safe haven currency ahead, both in terms of against the dollar Swiss and euro Swiss. I'm gonna check. There's a question from Sergey about Q&A on watching the recordings. It will be available for each of you to watch. So that will be the case. And that's it. It's a wrap from the Foundation Study of Cycles. Thank you very much, everyone. And we look forward to seeing you tomorrow and the next day as part of a 3-day event. All the best. Thank you very much.